Welcome back everyone to Data Science for Everyone. Today we're going to be looking at pitfalls for monetary policy. Banks are legally required to hold a minimum level of reserves, but no rule prohibits them from holding additional excess reserves. Excess reserves are reserves for banks hold that exceed the legally mandated limit. Volatility, the speed at which money circulates through the economy. Volatility is equal to nominal GDP divided by the money supply. Unpredictable movements and velocity. Rewrite the definition of velocity so that the money supply is on the left-hand side of the equation. This is called the basic equation of money. Money supply multiplied by velocity is equal to nominal GDP. Now recall that nominal GDP is equal to the price level, or GDP deflator, multiplied by real GDP. Money supply multiplied by velocity is equal to the price level multiplied by real GDP. Looking at this equation, we see that changes in velocity can cause problems for monetary policy. Velocity calculated using M1. Velocity is the nominal GDP divided by the money supply for a given year. We can calculate different measures of velocity by using different measures of the money supply. Velocity is calculated by using M1 money supply. It has lacked a steady trend since the 1980s instead of bouncing up and down. Unemployment and inflation. Most central banks believe that the primary task of monetary policy should be to fight inflation. This vision of focusing monetary policy on a low rate of inflation is so attractive that many countries have rewritten their central banking laws since the 1990s to have their bank practice inflation targeting. Inflation targeting is a rule that the central bank is required to focus only on keeping inflation low. Economists have no final consensus on whether a central bank should be required to focus only on inflation or should have a greater discretion. In a neoclassical view, monetary policy affects only the price level, not the level of output in the economy. For example, an expansionary monetary policy causes aggregate demand to shift from the original AD0 to AD1. However, the adjustment of the economy from the original equilibrium E0 to the new equilibrium E1 represents an inflationary increase in the price level from P0 to P1, but has no effect in the long run on output or unemployment rate. In fact, no shift in aggregate demand will affect the equilibrium quantity of output of this model. If you guys like this video, please make sure to comment, subscribe, and hit that like button, and I will see you guys next time. Bye-bye.